So I think we're eventually going to see something break in the financial system, which is going to wreak havoc across the board. And it could obviously spur a surge higher in precious metals because, let's face it, people are worried about stocks. They're worried about the currency, the fiat currency like the dollar, and people just don't trust the banking and the financial system. And that's why I think we're seeing precious metals do so well. There's the least amount of trust in governments and systems.
You're watching Silver News Daily. Subscribe for more.
They told you the 2008 crash was a once-in-a-lifetime event, that the system had learned its lesson, that safeguards were in place. But right now, behind the scenes, something eerily familiar is unfolding. Chris Vermeulen, a name known for catching market shifts before they go mainstream, is sounding the alarm. His charts show a parabolic setup eerily similar to the days before Lehman Brothers fell, before the global economy seized up, and before gold and silver erupted in panic-driven waves. But this time, he says the explosion will be even bigger. Not just a pop to $50 or $60. He's talking silver surging to $67 in a flash, before it grinds its way toward triple digits, while gold leaves $5,000 in the dust and eyes an inconceivable $12,000 target. That's not just a rally, that's a global reset. And here's the kicker. The panic hasn't even started yet. Silver just pierced through the $50 ceiling, only to fall back and catch its breath. But what happens when the dam breaks again? What happens when the banking system takes another hit and the public finally realizes the truth? That paper assets were never real, that digital numbers in an account can vanish, that the only thing left standing is a handful of hard, tangible ounces. Pet rocks no more, silver and gold are waking up, and this might be your last chance to catch the move before the curtain drops.
If I share my charts, I'll kind of give you a bit of a visual of how I see things unfolding here. So let me pull my chart up. If we take a look at the chart of gold, this is the daily chart. Obviously, we've had this kind of blow off phase, a short-term kind of momentum move to the upside where a lot of people piled in. Now, gold kind of had this feeding frenzy of if you weren't long gold these last kind of 6 or 7 trading days, you could cut the air with a knife. It was so intense that if people weren't in, they had to get in. And we could see it on the charts. We could see it with our custom indicators. There was just a lot of FOMO. And I was warning, we've got to be ready because usually when we hit this level of FOMO, we need to expect a sharp pullback. Now, it doesn't mean gold is topped. It just means we need a little bit to let a little air out of the bubble and to dissipate. And that's what we've seen right now. So we've seen gold pull back, silver, miners, platinum, palladium, all of them. But to me, it's actually just the first pause and pullback within this a much bigger move. I do think we're going to see gold end up rallying to roughly $5,100, $5,200 an ounce over the next probably 1 or 2 months. I think it could be very quick, depending on how things unfold. So, a lot of people, it's funny because we hit a measured move target right over here on gold, and we closed out a very short-term trade. Now, we were just trading an ETF just for this explosive momentum move. And when we got out, everyone wanted back in because the market kept going higher and they felt like they were getting left behind. Now it's interesting because I actually like gold down here, but people don't want to get into gold. They think it's top. They think it's pulled back. There's been a lot of damage. So that to me is a contrarian indicator. When everybody wants in, you got to be aware that we might have a pause or pullback. And then when other people don't want in anymore, that's usually when it's going to find a bottom and rally. So I like gold here. I think it's trying to still stabilize. As you saw, Elijah, that 1 day drop in gold, it was like a 5% move. Biggest move in like 3 decades for gold in a single day. So that created a lot of fear, and that fear's still in the market. And we kind of continue to see this trickle of selling in both gold, silver, platinum, palladium, and miners. And we're just going to let that fear finish. So let that kind of dissipate. And then I think that pressure will relieve. And then I think we're going to be off to the races to another big leg higher.
Silver's recent price action is sending shockwaves through the market, and it's no coincidence. In just a few short weeks, silver blasted through the $50 mark, a level that's acted as a psychological ceiling for over a decade, climbing to nearly $54 before being violently rejected. That retracement? It wasn't a sign of weakness. It was a classic blow-off phase, a parabolic top forming under pressure, followed by a snapback as traders took profits. But underneath that pullback lies something far more important: momentum. The RSI remains elevated near 70, showing the market is still surging with energy, even after the drop. That kind of technical setup, where bullish sentiment survives a sharp correction, often precedes the next leg up. And if the Fibonacci levels hold, we're looking at support zones around $44 to $46 setting the stage for the next explosion. But this isn't just about lines on a chart. This is about fear. It's about traders front-running what could be a systemic failure. Remember what happened in 2011? Silver went from the low 20s to just under $50 in less than a year, riding the wave of dollar debasement fears and debt ceiling chaos. Today, we've got a far more combustible mix: global liquidity tightening, geopolitical uncertainty, and retail investors waking up to the idea that the financial system isn't just fragile, it's rigged. And in that environment, technical setups become self-fulfilling prophecies. Break resistance, and the floodgates open. Lose key support, and we get one last dip before the rocket ignites. Right now, silver is teetering between those two outcomes. But whichever way it tips, the magnitude of the move is likely to catch everyone off guard.
The one on the left over here is the 2007-2008 stock market top. We saw the S&P 500 hit an all-time high. We're kind of at that level of right now where we are on the right-hand chart. And the S&P 500 is at an all-time high. What we've also seen here is this yellow line is the chart of gold. Now, gold and stocks have been rallying for the last couple of years substantially to the upside. It's the same where we are right now in 2007. When gold rallies, as you and I have talked about in the past, Elijah, we got to be aware something big and bad is brewing that we just don't know what it is and we don't know when it's going to happen. But gold is generally a warning sign that there's going to be some big change in the economic kind of cycle and potentially the stock market cycle as well. So what's interesting is if we look at the chart from 2007, the stock market started to show some weakness. We started to get some red bars, which we're starting to get some red bars where we are right now. But if we take a look what happens to gold in the stock market, so the stock market starts to struggle, stock market starts to sell off. And what's happening here, I think, is money is moving out of stocks and it's always looking for a return. Money is looking to make money. So that money is coming out of equities and it goes into gold, which is why we see gold shoot higher. And gold ends up having this very big rally. Rallies about 30+% to the upside, while the stock market actually sells about 20% off. So that's a pretty interesting scenario. Now, if we kind of go back and look at where we are right now, look at these other layers of the precious metals space. So these charts below is the chart of GDX, which are gold miners. We've got silver, platinum, and palladium. And we just had this first wave, this feeding frenzy of everybody wanting to get into gold miners. They all wanted to get into silver, platinum, and palladium. So now the precious metal space isn't kind of a sleeper. Now it's actually got the masses starting to move in. And this is the first pullback. Now, what's interesting is if we just fast forward a little bit, we see the markets all cool off for a few weeks. This is a weekly chart of all of these. So, for about a month and a half, they cool off. And then what happens is the stock market tanks at the top and gold, silver, and the whole precious metal complex, they all shoot higher dramatically. They all go higher by about 30 to 60%. All of the different commodities here. And so if I was to just scroll back to where I think we are right now in this market, where gold's starting to pull back a little bit, we're having gold pull back where we are right now. Take a look at the same charts. We have the whole wave of people moving into miners, platinum, palladium, platinum and palladium here, all down below. So we've had this first wave. And I believe if we were to scan forward to where we are, I think we are going to see all of these have one more big push higher. So this little hiccup in gold right here, I believe is the little hiccup in gold where we are right now. I think we're just seeing this first little bout of fear and panic, and it's pulling a little bit of money out of precious metals and things. But I think we're about to see another big push higher. So that's kind of what what the charts are pointing to at this point.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. be subscribed to Silver News Daily on YouTube, turn on the notification bell, comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
While silver's chart is flashing signals of a breakout, the supply side is quietly screaming a different warning. One that could amplify the next leg higher into something far more chaotic. For the 5th year in a row, the silver market is operating under a deficit. In 2025 alone, that shortfall is projected to hit 149 million ounces. And no, mining isn't catching up. Global mine production is crawling, barely growing 2% this year, mostly thanks to delayed projects and flat output from lead and zinc operations. And even with recycling hitting a 12-year high, it's still not enough. Total supply is lagging further behind soaring demand, and it's creating a bottleneck with potentially violent consequences. This isn't just about future deficits, it's about years of cumulative shortage already baked into the system. Since 2021, nearly 700 million ounces have vanished from the supply side. That's almost 10 months of global production just gone. And while new mines are coming online, like Terranera and EC120, their impact will be staggered and slow. Development cycles in silver mining are notoriously long, often taking more than a decade from exploration to full output. In other words, the cavalry isn't coming anytime soon. Meanwhile, industrial users, especially in solar and EV sectors, are locked into their consumption needs with no substitutes. And that's forcing them to quietly hoard supply while retail investors focus on price charts. And here's the brutal truth. Unlike gold, where central banks can backstop liquidity with massive reserves, silver has no such cushion. If the physical shortage continues to widen, miners won't be able to meet demand, and industrial buyers could begin bidding directly against investors for the same finite pool of metal. That's not just bullish. That's the kind of setup that breaks markets. We're heading into a phase where price suppression won't just fail, it'll backfire spectacularly.
Is over with, I do think we could see it pull back a little bit more. So using Fibonacci retracement, which you and I have covered many times, a very, very powerful tool. Fibonacci sequences in the universe. It's everywhere. It really is, to me, one of the ultimate tools to get an idea of where price could pull back to and also where it could run to. And that's how I really get most of my targets. Now, if we use Fibonacci retracement from the May low, from this giant bull flag pattern, to the high that we saw recently and where we are, usually the market wants to pull back into this sweet zone here. This is a 38% retracement or pullback from the high, all the way down to about halfway of that move. So we have already seen gold kind of tag this level. It's already touched that 38. The question is it going to kind of drift down a little bit more and scare out a few more investors before it wants to turn that corner and go higher? So there is potential for it to work itself down and create a lot more fear and create a bottom here. But overall, it's done most of the downside, I think, is done. If we were to look at this from a percentage standpoint, there's potential for gold to pull back another 3-5% potentially if it was to push that to the max. Now, the nice thing about Fibonacci is even if it comes down to this level or has bottomed, we can project where it should go next. And that's going to be based off this last run, the cycle low to a cycle high. And we can come down to the current pullback that it's had. This will tell us where gold is likely to move to. So it's telling us we should see the first rally to about 4,600, 4,700, and then it'll go up to about $5,100 per ounce going forward. So there's a pretty nice projection. Obviously, if gold gets some traction here, it could really, really pick up speed and go parabolic and give us, on the monthly chart, a couple huge green bars to the upside going forward. So that's kind of my take on gold at this point.
Industrial demand isn't just rising, it's exploding, and silver is at the core of that transformation. In 2024, the world consumed over 680 million ounces of silver for industrial use, and that number is already racing towards 700 million for 2025. The driver? A global green energy push that's gone from ambition to policy-backed mania. Solar alone now devours nearly 20% of all silver supply, and it's not slowing down. With governments around the world locked into net zero targets, panel production is going vertical, and the tech inside those panels is changing fast. N-type solar cells, which are quickly becoming the standard, require up to 50% more silver than previous generations. That means solar demand alone could hit 261 million ounces this year, up 25% in just 12 months. And then there's the EV boom. Every electric vehicle on the road uses 2 to 3 times more silver than its gas-powered counterpart. From batteries to charging ports to internal circuitry, silver is irreplaceable. Automakers know it. That's why forward contracts are being locked in aggressively. EV silver demand is projected to hit 90 million ounces this year, and with production forecasts pointing skyward into the next decade, that number could double again before the market can even react. But here's what few are talking about: the AI revolution. Data centers powering artificial intelligence require specialized servers with high conductivity components. And guess what metal is crucial for thermal regulation and connectivity? Silver. These AI installations consume 2 to 3 times more silver than traditional centers, and as AI integration expands globally, this silent demand driver is only going to accelerate. This isn't a short-term spike. This is a structural shift in how silver is consumed. Unlike speculative investment demand that comes and goes, industrial usage is sticky, inelastic, and deeply embedded in technological advancement. And that means even during price surges, companies have no choice but to keep buying, squeezing an already tight market and setting the stage for parabolic price moves.
So if we were to kind of take where I think silver could pull back to, now I'm not going to use this particular sharp drop that we had. I think if we were to look for a retracement in silver, it has tagged the 318 level. I do think it could potentially work itself down to maybe even, $42, $43 an ounce if we have one more little bout of selling. But overall, when we look at this, the upside target for silver is pretty substantial at this point. If we take a look, we could see silver run all the way up to about $67 per ounce, which would be obviously a couple big green monthly bars. And I like to use silver for this analogy, which we need to be aware of, because things that go straight up in price in a parabolic kind of bubble phase, they tend to come straight back down. So let's just go all the way back to the last bubble that you even talked about way back here. You got to be leery. You got to be a little worried when things go straight up like this, and everybody seems to be wanting to move into it at the same time. If we were to look at this and say, hey, where's that the $67, potential upside, we could still see, very big, huge spike to the upside in silver, a couple big green bars. We just need to be aware when things go straight up like this, they can come back down very quickly, and then they need to build a new base. So that's kind of where we are. I think there's quite a bit of upside in silver in miners. From there, I think eventually we'll see it pull back to some regard. It'll build a new launch pad, and then I think we're going to go a whole lot higher. In fact, I think it'll be something similar. Let me just go back to 2008. I think it'll be the same for gold and silver, whereas silver had this parabolic move. It shot up just before 2007 market top. And then we saw it pull back about 60+%. Well, I think we're going to see something similar to that, because I think if we see it rally up and we go into a financial reset, then I think we're going to see it pull back fairly substantially. And then from there, I think it's actually going to start a new rally that could send it way up into the 80s and the 100 mark going forward. And if I was to kind of just drop back to gold for this scenario as well, I think gold would eventually find a top here, and then it would pull back into a consolidation zone, just like in 2008. It pulled back about 34%, and then it goes into a multi-year rally. So then after that, I think gold could be up in the $8,000, $10,000, $12,000 mark. But there's a roller coaster ride between here and then, right? I think we're going up a hill first, and then we're going to go over the edge, and everybody's going to scream for a little while, and then it'll stabilize, and then I think we go up for a much bigger ride. So I'm bullish on gold and silver long term. Short term, I'm bullish, but if you look forward, like over the next 6-8 months, they might, they might be back where they are right now, or they might be a little bit lower. So long-term investment wise, I mean, it's still a long-term play. And short-term traders, I think, have got potential for another big push to the upside.
Something extraordinary is unfolding behind the curtain of the COMEX silver market. A structural unraveling that could detonate the next price surge. Open interest in silver futures hit record highs in Q3 2025. But that's not the real story. The real story is physical delivery. October alone saw a 100% spike in physical deliveries on select contracts, and eligible inventory is now hovering at just 90% of open interest. That's a ratio that should never exist in a healthy liquid market. What it means is simple. More traders are demanding real metal, and fewer are willing to trust paper claims. The COMEX is being drained in real time, but the cracks go deeper. Bid-ask spreads have widened by 20%. Premiums over spot have jumped 15%, and arbitrage opportunities are evaporating as market makers grow increasingly uneasy. This isn't normal volatility. This is fear. It's a system slowly losing confidence in itself. In the past, large institutions would roll over contracts or cash settle quietly. Now they're taking delivery. Why? Because physical supply is under siege, and when trust in the paper game breaks, the scramble for real ounces begins. We're also seeing a silent accumulation from ETFs. Inflows surged earlier this year as retail and institutional investors piled in, and if that trend resumes, it will collide head-on with a market already starved of metal. The risk? A short squeeze, not just in price but in availability. A moment where buyers flood the market, only to discover that what they want no longer exists in sufficient quantity. At that point, silver doesn't just move, it jumps. Spreads blow out, premiums skyrocket, contracts fail, and confidence in the entire pricing mechanism fractures. This is how parabolic moves begin, not with euphoria, but with quiet panic building inside the infrastructure that props up the illusion of abundance. And once that illusion breaks, it's not the paper price that will matter. It's whether you can get your hands on the real thing.
The stock market it's still in an uptrend. It's not the strongest stock market. Like, it's not a full-on broad market rally. The Magnificent Seven are doing a lot of the heavy lifting. But no matter how strong or how weak the market is, when it's trending higher, you do need to own it. You need to be long a trend. And so the trend is still up. We've seen a recent pullback. To me, it's actually the big barometer really is the fact that it's Magnificent Seven driven still. We're kind of in this AI bubble phase where people just are investing left, right, and center into AI and buying anything that has any AI stock that has, chips and all that stuff. Gold and silver are, to me, kind of the warning sign that something is unfolding that people aren't going to like. So, at this point, you really just have to ride the trend. They say the trend is your friend, and the trend's more likely to continue than it is to reverse. So that's why you need to really follow price. Don't get too caught up in the fundamental analysis and all of that stuff. And, the warning sign in the stock market is that it's not a super strong market. When you look under the hood of the markets, it's not super strong in terms of all the market participants. A lot of stocks are struggling. And again, gold is just that barometer. So I'm just kind of repeating myself here.
As silver teeters on the edge of a supply squeeze, there's another force lurking in the background. One that could ignite the powder keg. The Federal Reserve all year, the Fed has walked a tightrope between containing inflation and avoiding systemic instability, but their latest hawkish pivot sent shockwaves through every asset class. In late October, rate hike expectations re-emerged after months of dovish signals, triggering a 10% correction in silver almost overnight. That wasn't a coincidence. It was a reflexive response to tightening liquidity. But here's the catch. The Fed can't tighten much longer without breaking something big. The bond market is already flashing distress. Yield curves remain inverted, debt servicing costs are ballooning, and real yields are crushing risk assets. That kind of environment pushes capital back into the dollar, temporarily. But when the pressure becomes unsustainable, when banks begin to wobble under the weight of bad debt and liquidity dries up in the repo market, the Fed will be forced to pivot again. And when they do, silver won't just bounce. It will slingshot. This isn't just about rates, it's about credibility. Faith in central banks is eroding. Each contradictory statement, each failed forecast, Each policy whiplash chips away at the illusion of control. Investors know it. They're watching gold hold its ground while silver coils with nervous energy. The last time the Fed paused and hinted at cuts during a fragile recovery, gold surged and silver followed with ferocity. And right now, we're heading into the same setup, except with even more pressure, more debt, and more systemic fragility. So ask yourself, what happens when inflation proves sticky, economic growth slows, and the Fed has no bullets left? What happens when confidence collapses, not just in the dollar, but in the central bank itself? That's not a policy dilemma. That's a trigger. And in a market already primed with tight supply, industrial hunger, and record ETF accumulation, that kind of trigger doesn't just lift prices, it detonates them. Gold is already moving. It's pushed past resistance, flirting with new highs, and sending a clear signal that investors are beginning to lose faith in fiat stability. But if you think gold is the end of the story, you're missing the point. Because silver has always been the lagging missile behind the golden launchpad. History shows it time and again. When gold breaks out, silver waits, then overreacts. It's not a maybe, it's a pattern. In 1980, gold soared to $850, but silver shot up from under $6 to nearly $50. In 2011, gold peaked just under $1,900, but silver rocketed from $9 to $49. In both cases, silver's percentage gain dwarfed gold's. Right now, we're standing on the same edge. The gold-to-silver ratio remains elevated near 80 to 1, signaling extreme undervaluation for silver. And that ratio doesn't stay there forever. When it corrects, and it always does, silver doesn't just play catch-up. It slingshots past expectations in a parabolic burst. Why? Because silver is a smaller market. It's more volatile. It's more sensitive to investor sentiment. And when the crowd finally turns their attention toward it, the move becomes self-feeding. Momentum attracts momentum. FOMO kicks in, paper shorts scramble to cover, and just like that, what was a steady grind in gold becomes a vertical panic in silver. But here's the twist. This time, silver isn't just playing second fiddle. It's got its own drivers: industrial demand, supply constraints, COMEX strain. All of these forces are converging at once. So when gold leads the charge and the market finally wakes up to silver's relative value, the move may be even more dramatic than anything we've seen before. The past two supercycles sent silver nearly 10 times in less than 2 years. And based on the current setup, the coming wave could leave even those gains in the dust.
Certainly. Now, when it comes to, I guess, some of the fundamental reasons why the stock market might roll over and why gold has been rallying, if you look at the last couple of years, you mentioned how that is signaling something. Do you have any idea of what that might be going forward?
Yeah, I'm not sure. I think we'll probably see, I mean, valuations for stocks are still pretty ludicrous up here. So, the PE ratios are out of whack. So things seem to be overvalued. I think we're going to see something break down probably in the financial system in terms of banking. I mean, we're already seeing credit, mortgage-backed securities is higher than it's ever been. The delinquency rates, we're seeing problems with, I think, the banking sector. Everything seems to be swept under the rug. So I think we're eventually going to see something break in the financial system, which is going to wreak havoc across the board. And it could obviously spur a surge higher in precious metals because, let's face it, people are worried about stocks. They're worried about the currency, the fiat currency like the dollar, dropping in other countries in their own currencies. And people just don't trust the banking and the financial system. Like, banks take your money. It's supposed to be a store your value, store your money. Instead, they just gamble it and they go bankrupt and you lose everything. And that's why I think we're seeing precious metals do so well. There's the least amount of trust in governments and systems right now. We know all the data for economic data they keep just changing the calculations and formulations for everything. So, what used to be normal economic data, they've now tweaked things so it still looks good, I think. But the reality is we had the original formulas that we've always gone from. Things are not that strong. So people are moving and buying, their big gold pet rocks and their silver pet rocks and their platinum and palladium because they want to be out of the banking system in case something implodes and blows up.
No, if we look at the dollar index, I know other analysts are thinking that could rally soon, which could put pressure on metals. What do you anticipate there? And do you think it's possible, it has happened in the past, where the dollar actually rallies with precious metals as well? What do you anticipate for that going forward?
Yeah, I think the dollar has it obviously had a very strong uptrend early in the year. Now it's gone down, and now I believe it's turning a corner. It's starting to head higher. I think we could see the dollar index back up at 110, maybe even at 116 or something. You look forward a year from now potentially. That will obviously put some pressure, some headwinds on metals. But we can see in this specific market environment, we can see the dollar move higher. We can also see precious metals move higher. They're not always an inverse relationship, as you know. So I'm not too worried about the dollar moving up just yet, affecting gold too much. I think there will be a point eventually where there's enough fear in the global system that people are dumping stocks. Eventually, the dollar will start to move higher. The US dollar index tends to rally and strengthen during uncertainty and chaos. And I think when the dollar really starts to put in some very big extended runs, I think that will put pressure on metals, along with liquidation. Margin calls and things like that will naturally have people forced to sell gold and silver, even if they don't want to, because they hold a bunch of equities and different assets, could be real estate, and they get underwater, they get backwards on them, and they're forced to sell. So I believe we're going to see a strong US dollar over the next 6, 8, 12 months here.
And if our viewers are interested in learning more, they can go to thetechnicaltraders.com. Before we leave our viewers, did you have...
Chris Vermeulen's forecast isn't just a bold guess. It's a roadmap for what happens when confidence evaporates and the herd turns to hard assets in desperation. He sees gold hitting $5,100 in the next phase, with silver surging to $67. And that's not the ceiling. That's the ignition point. Once silver crosses that threshold, the psychology of the market shifts. Retail floods in. Institutions panic buy. Media headlines flip from skeptical to sensational. And suddenly, everyone's chasing a market that's already running. This is how parabolic moves feed on themselves. The faster silver rises, the more it validates the fears that triggered the move in the first place. But there's something deeper in Vermeulen's warning, a signal that this isn't just a cyclical move, it's a structural revaluation. When gold begins its ascent toward $12,000 as he projects, it won't be in isolation. It will drag silver with it, not in dollar terms alone, but in status. From industrial input to monetary safe haven, from commodity to currency alternative. The shift will be psychological, cultural, and financial. Silver's historical role as poor man's gold will vanish. In its place, a repriced asset no longer limited by decades of manipulation or neglect. And it won't be gradual. Vermeulen calls it pet rock panic, a moment when the world suddenly realizes that all the digital wealth, all the ETFs, all the balance sheet numbers are backed by nothing. When that moment hits, people won't just want silver, they'll need it. Not as a hedge, but as a lifeline. And with global supply chains already strained, physical stockpiles thin, and mining unable to respond quickly, the price could gap up, leaving those waiting for a dip permanently on the sidelines.
Yeah, I mean, the markets aren't that complicated, really. When you peel back all the news, forget the politics, forget the fundamentals, forget the Fed and all that stuff, price action goes up, down, or sideways. And so if you peel things back to that level, you have to attack it with a strategy. You have to have a way to identify when something is trending up and it's a strong enough trend to own. You need to know when it's trendless and you should just get away from it until it starts something new. And you need to know when something falls. Technical analysis, which is what I focus on, does exactly that. We can follow the markets very closely. We know when to jump in when a new trend starts. We know when to trim profits when it's starting to weaken. So, the average investor, most of them don't understand this. They don't know how to do it. And so they feel kind of lost. But really, it just comes down to follow price. If it's moving higher, you want to own it. If it's not, get away from it and go find something else. And so you need a strategy. That's what I offer at the Technical Traders. I manage my own money. I share my exact portfolio, my allocations, my trades, my daily analysis with subscribers. We all trade. We all make money together. And I focus on protecting capital first and then growing it. I don't look to swing for the fences. You won't catch me into, penny stocks and all that stuff. I'm like, how do we manage, multi-million-dollar portfolios very easily with a couple ETF trades, 5 to 12 adjustments a year?
Everything we've just walked through, every chart signal, every supply strain, every surge in industrial use, every shift in institutional behavior is pointing to one thing. Silver is on the edge of an eruption that could rewrite the financial order. This isn't hype, it's convergence. When banking trust breaks down, when real assets become the only assets that matter, silver doesn't just rise. It leaps violently, unpredictably, and with a vengeance born from decades of suppression. Chris Vermeulen's $67 target may sound bold, but in this context, it's the floor, not the ceiling. We've seen it before. In 1980, in 2011, each time driven by fear, by inflation, by disbelief in paper promises. But this time, it's bigger. Supply is tighter, demand is broader, and the world is more interconnected and more fragile than ever before. You don't get setups like this often, and when you do, they don't wait around. So if you've been watching from the sidelines, if you've been waiting for a perfect entry or a clear signal, understand this. By the time it's obvious, it'll be too late. Silver is about to do what it always does. Move when no one expects it and reward those who were prepared, not those who reacted. If you want to stay ahead of what comes next, make sure to subscribe. And remember, this isn't financial advice. Always do your own research and speak with a professional before making investment decisions.